Right now, we're going to talk about what we can expect from the Fed this week. I want to bring in Jeffrey Lacker, former president of the Richmond Federal Reserve. Jeffrey, it's great to see you this morning. We're all trying to make sense of what the Fed will do and what they should do. So why don't you break it down like that first?
Well, I think they should go ahead with a 25 basis point increase. I think they have still more work to do to fight inflation. And I think to pause now would send a signal of concern and worry and convey that they know that things are worse than people on the outside think. But I take Jay Powell seriously last December, and I think he was right then that what happens at this meeting or any given meeting is less important than the destination of this journey. So I think the harder problem they have now, the thing that's trickier, is what to do, what shows up in the summary of economic projections, what the dot plot looks like. That could go all over the map. You could have a wide divergence of views within the committee, some marking down their path. But on the basis of the inflation and real economy data that's come in since the December meeting, the last summary of economic projections that were released, you would think that the path would be marked up. So I think that's the critical issue for them. He may take a pass. They may just punt and say, we're not releasing anything. They did that in early 2020. But I think that would be sort of a bit of a dereliction now.
Right.
I think they can. Yeah, go ahead.
Did you see, we had Warsh on in the last hour, and he effectively said two things. He said there should be regime change. He says there should be a massive pause. And effectively, he thinks this dot plot game, if you will, I don't know if you want to call it a game, has just been a terrible, terrible mistake. What do you think?
So those dots, any of the paths that the Fed releases are the center of a forecast of a range of possible outcomes. I think people understand when you say that the temperature in Midtown Manhattan at the high on Thursday is going to be 55 degrees, that it could be higher and lower than that. And I think sophisticated financial market players understand that they're just giving you the midpoint of a range of possible outcomes that they think are likely.
Yeah, so, but I mean, we've also had situations. It's like the weatherman. When the weatherman says there's going to be a massive storm and there's no storm, or the weatherman says it's going to be, sunny out and it actually is raining. We've also had that too.
I think the deeper critique is that the Fed, the way and the structure in which it provides its forward guidance doesn't provide a sense of the way in which policy is likely to depend on the data. And this is where the role of rules like Taylor rules that have been sort of fit to pass data and that capture the sense from history of how the Fed has behaved when it's been successful at bringing inflation down. Providing those would give markets more information. Right. It would let them adjust their estimates in between meetings with more alacrity and more accuracy. I think conveying a sense of how policy is likely to depend on future data would be more valuable than further elaborating what they do now.